I appreciate the opportunity to bring the content of this course to everyone. Tony, Russ's personal accountant, is going to share with you a lot of great information of what a resource Russ has put together for everyone today. So he's going to fill in a lot of the details about the intricacies of deductions and if you get audited and things like that. But what I'm going to do is part of what Tony's going to talk about is to get your maximum tax savings, you really need to have a corporate entity. So what I'm going to do for the next 20 minutes or so is walk you through some of the rules around forming a corporate entity. Why should you consider doing it? What are some of the tax advantages of it? And what are some of the other benefits that come along with it? I do this through a website that I've created called allfilings.com, where I actually provide an incorporation service. And you can see my contact information is on the bottom of the screen there, Steve at allfilings.com, or there's my phone number. So make a note if you have questions afterwards. I welcome talking to anyone one-on-one. So let's go ahead and let's jump in. Let me tell you what I'm going to cover here for the next little while. First of all, we're going to talk about what forming a legal entity means. What does it mean specifically for you as a real estate agent? And then once you're incorporated, that's great, but there's a couple of things you need to do to make sure you're getting all of the benefits and the advantages of being incorporated. So the first main point that I want to impress upon everyone is if you're in the real estate business, and even if you're incorporated or not, even if you're brand new to the business or you're a seasoned veteran, if you're doing it full-time or part-time, it doesn't matter. You are running a business. And as the person running that business, you're the boss. And as the boss of that business, you get to make certain decisions. Decisions that impact things like how do you best protect yourself, your personal assets, your family assets, and how do you hold on to as much of the money that you can via some tax saving strategies. So we're going to come back to this point in a little while, but that's the main thrust. You're already running a business. Let's take advantage of some of the things at our disposal to get the most benefits out of it. In terms of benefits, the main thrust of this course is tax savings. We're going to focus on that, but I believe I would be doing a disservice if I didn't touch on some of the other benefits of incorporating, which are asset protection, adding credibility to your business, and yes, even lowering the risk of getting an IRS audit. So first of all, let's talk about what it means. If you form a corporate entity, and we'll talk about what some of your choices are. People have heard about S Corp, LLC, PA, Corporation. We'll talk about that in a second. But whatever it is, they're all designed to be a separate legal entity, and they all have their own privileges and liabilities distinct of their owners. It has the legal capacity to enter into agreements or contracts. It can incur and pay debts. It can sue and it can be sued. Now, nobody likes that word, but if somebody's going to sue, you'd rather have your corporate entity be sued than you personally. But the main point is it's going to be held responsible for its actions separate from the owner. So you see that word separate is underlined on the bottom and it's bolded on top. That's the main issue with forming a corporation, is to separate your personal and your business assets. So if you come to this class today and you are not currently incorporated, chances are about 100% that you're operating as a sole proprietor. That's why I said before, you're running a business. You're already a business owner. You own it as a sole proprietor. What is that? It's you as an individual, because you are the individual licensee. You own a business. It's your real estate business. You own it alone because you're the individual licensee again, and not as a separate legal entity. As such, you have no legal protection. Why? Because your personal and your business assets are combined under the same umbrella. There's no separation. Something we do see in real estate is something called a general partnership, where two or more people agree to become partners in a business venture. So let's say Russ and I are working in the same brokerage. We decide to pool some money for marketing. Deals come in, we work them together, and then we close them and we split the money. So that would be sort of a general partnership. This is even a little more risky than a sole proprietor, because not only are, in this case, my personal and business assets combined under the same umbrella, but now I got Russ's personal and business assets combined under it. And we're both responsible for each other. So general partnerships even a little bit more tricky than a sole proprietor. So if that's what you are now, what are your options? So your options are, now, I lived in Florida for 30 years. I have done this in corporation business for 8 years, primarily in Florida. This is a very state-specific topic, so I'm going to refer you a couple of times to make sure you check with your own state, particularly when it comes to your real estate commission, because there are certain rules in each state and they differ all across all 50 states. But the bottom line is, in just about every state, you have two options. You can be a corporation or you can be an LLC. In some states, the states recognize realtors as professionals. So in those states, you would become a professional corporation. In Florida, for instance, you get the designation of a PA. It stands for Professional Association, because in Florida, real estate agents are considered professionals. So when they incorporate as a corporation, they become a professional corporation and get the PA designation. But it's just a corporation. You can also be an LLC, or a limited liability company. So let me talk a little bit about each of these. When a corporation is first formed, it takes on the status of a C corporation. And some of the benefits of a C corporation is very good for asset protection, but it's not great for us as real estate professionals from a tax standpoint, because C corporations get hit with something called double taxation. What do I mean by that? Let me tell you, my company is Dahlia Sales and Marketing, that all filings is an asset of. Let's just say Dahlia Sales and Marketing does $100,000 in gross revenue, and it has $50,000 in legitimate deductions. So it has a net profit of $50,000. Well, right now the corporate tax rate is 22%. So when Dahlia Sales and Marketing does a corporate tax return and it nets $50,000 profit, it sends in the corporate tax return and it has to cut a check for $11,000 to the federal government for that corporate tax. But Steve Dahlia, individual, has to live off of that money. So when Steve Dahlia, the individual, lives off of the $39,000 that is left, he pays tax on that money again as income tax, right? So there's the double taxation. So you might hear people say, well, you really need to become an S Corp. So an S Corp is not a physical corporation. An S Corp status is just a filing classification that you tell, or you elect to be classified as by the IRS, and you tell them, I'd like to be taxed as an S corporation. And here's how it works as an S corporation. That same scenario with Dahlia Sales and Marketing. I gross $100,000. I have $50,000 in legitimate deductions that Tony's going to talk about shortly, and I have a net profit of $50,000. I still have to do a corporate income tax return, but this time I don't have to send that $11,000 to the federal government. This time now that net profit flows through to me personally, where I handle it differently. So I'm not getting hit with the double taxation. So I'm going to come back. I'm going to show you a tax example here in a minute. Now, so that's a corporation. and then telling the IRS you want to be taxed as an S corporation. Remember, an S corporation is not a physical corporation. You be either a corporation or an LLC, then you tell the government you want to be taxed as an S corp. So a limited liability company is sort of like a hybrid between that sole proprietor and partnership stuff we talked about earlier and a corporation. But the bottom line is, it too can tell the IRS it wants to be taxed as an S corporation, and it also gets limited liability. You get that separation, and with the S corp, you get that flow through tax treatment. So the biggest question I get is, which of these is better for me? And the answer is really neither. You should have one, because the what is better is having one versus not having one, right? So let's look at what they look like side by side. So in the middle column, I say PA, but that's a corporation, because remember, PA is just a professional corporation in Florida. So any corporation and an LLC, they are more similar than they are different. They both create a separate legal entity from the owners. The owners have limited liability in both of them. They both can have pass-through tax treatment. That's through telling the IRS you want to be an S corp. The only difference is a corporation is supposed to have a yearly meeting and keep minutes of what occurred at that meeting. But in a lot of states, a realtor has to be an individual 100% owner of the corporation. So you have to have a meeting by yourself and keep track of what occurred at that meeting, which is kind of a joke. And the good news is you don't have to submit those minutes to anyone, right? So don't get caught up on that. I get clients of mine that really are like, they stress over this. Oh, I don't know what to do, a PA or an LLC. What about those minutes? Not a big deal. Okay, so hopefully we just added some clarity to what most of your choices are in most states, what they are, what an S corp is, and how they're very similar. So doesn't matter which one you do as long as you get incorporated. So I'm going to buzz through some of the reasons why personal asset protection is important, and it's a big part of forming a corporate entity. I've had clients of mine that tell me their accountants or CPAs tell them, oh, you don't have to incorporate till you're doing $85,000 or $50,000. I'm going to show you a tax example in a minute that is going to contradict that and say, no, I don't care if you're only doing $15,000 a year. It still makes sense from a tax saving standpoint, but certainly from an asset protection standpoint, it makes sense from day one. Because, as these bullet points say, we live in a litigious society where we can get sued for legitimate and even non-legitimate reasons, regardless of guilt. So if you're operating under a corporate entity, it helps to protect your personal assets. Why? We talked about it earlier. Both corporations and LLCs allow owners to separate, there's that word again, separate and protect personal assets. How? You'll be operating under a corporate veil, which is the virtual wall between the assets of your corporate entity and your personal assets. So sometimes realtors say to me, yeah, that's great, but I don't really need that. Well, actually, Rice Insurance Services might disagree with you. They did a report years ago on the 10 most frequently made claims against real estate licensees. And here's the list. You can Google this, and it goes into a paragraph on each one. But the bottom line is realtors do get sued. And if you don't have a corporate entity, you're out there exposed. All of your personal assets are at risk. Whereas if you had a corporate entity, you would have that separation. And why is this important? If you've driven down any major highways, you've seen all these billboards by a lot of law firms trying to get somebody to sue somebody else. They insert themselves in the middle and they make a fee. So it is real. Hopefully you go your entire real estate career and never get sued, but having a corporate entity is just another layer of protection. Sometimes people say to me, well, I have E&O insurance. Do I really need a corporation? I don't know. I can't answer that, but I use the analogy like, You know, we've had seatbelts in our cars for a long time, and then airbags came along. So once we got airbags, did we give up the seatbelts? No, we took both. So we want maximum levels of protection. So again, hopefully you go your whole career and never get sued. But the one thing is certain, that every year you're in business, you're going to have to do a tax return. And what's the number one goal when you do your taxes? A lot of people say pay no taxes, pay as little as possible. Well, I have a friend, he works in the enforcement division of the IRS. He's one of the guys that does the audits. And his answer to that question is simple. He says, just pay what you're legally obligated to pay. But guess what? We as realtors, we overpay dramatically. Why? Because most of us are not incorporated. So let's talk about that. From a tax standpoint, taxes are probably your biggest expense every year. And remember, like we talked about earlier, you're the boss. You get to make decisions on how you protect your assets and how you hold on to as much money. So as that middle bullet says, and I'm guilty of this too, you spend time learning how to use new technologies, lower your mortgage payment, reduce your gas bill. I was just fighting with AT&T last month for a $30 difference on my bill when I could be saving thousands or tens of thousands on my tax bill. So as a business owner, you have more tax saving options to keep more of your own money. So thank goodness you're here today. You're getting educated. You're taking action to keep more of the money that you earn. So next I'm going to get into a very simplified tax example, and we're going to talk about what your tax obligation might be now if you're not incorporated, and what your tax obligation could be if you had a corporate entity. And again, this is a simplified example, and I'm going to strongly recommend that you talk to your own advisor about this. And this is not financial advice. This is not legal advice. I'm just sharing with you an example. So what we're going to look at in the middle column, we're going to look at what a realtor's tax obligation might be if they were not incorporated, like most of you are operating today as a sole proprietor, doing your taxes on a 1040 and itemizing your business deductions on a Schedule C. Then we're going to look at what the tax obligation might be if you were incorporated in that right-hand column. Excuse me. So I picked a number out of the air. You're probably doing more than this. If you're doing less than this, these numbers are proportional all the way up to like 160,000, where some of the numbers change a little bit. So we're going to assume that this is a realtor, and let's just say it's a she for argument's sake. She's got a net income of $60,000. So this is after splits and after deductions, right? Because we're not paying tax on anything that we deducted. That comes off the top. So I've got $60,000 of taxable income now, or adjusted gross income. The first thing that this realtor is going to have to pay is in the middle of the screen. That's self-employment tax. Tony refers to a 15% savings. You'll hear from him shortly. And that's where the 15% comes from. So the 15.3% is your self-employment tax. It's comprised of Medicare and FICA or Social Security. Now, some of you may still have part-time jobs. You might have just left a job. You might still have a job. And you say, well, I only pay half of that they take out of my check. That's right, because your employer all along was paying the other half. So you pay 7.65, your employer pays 7.65. But now, as a sole proprietor, independent contractor, 1099 person, you're responsible for both sides. I make a joke about like real estate, like both sides of a real estate transaction. You pay both sides. So in this case, excuse me, $9,180. Then the next chunk is, this example is Florida. We don't have a state income tax in Florida. Your state probably has a state income tax. So whatever it is, these numbers don't matter because they stay the same in both columns. So you have to pay your self-employment tax, your state tax, and your federal tax. In this case, That totals $20,000 for this individual. So now let's go to the right-hand column and assume that this particular realtor, that she was incorporated. The same $60,000, however, this time you'll notice she's taken that money in two separate buckets. She's taken a salary of $24,000 and she's taken a distribution or profits of the company of $36,000. Let's talk about what this does to the self-employment tax. It brings it down from $9,180 to $3,600. So we're going to talk more about this in a second. This part of the equation stays the same. So the total tax bill goes down from $20,000 down to $14,500, or a savings of $5,508. So that's substantial, right? That's a nice car. That's a $400 and something lease payment on a vehicle. Let's put this in perspective, because sometimes people look at this and say, oh, that's not a tremendous amount of money. Well, I think it is. And let me give you a shortcut. If you're thinking about this class 3 months from now, 6 months from now, and you wanted just a real rough way to figure out how much can I save, this number is not quite, but it's roughly 10% of this number, right? So that's why I say even if you're only doing $15,000, you're going to save about $1,500, and it's going to cost you a lot less than $1,500 to get incorporated. So that's why I show you these numbers. So in this case, $5,500. Let's put this number in perspective. Let's go back here. If she grossed 60, well, netted 60, I should say, and she paid a total tax bill of 20, that means she netted $40,000 over a 12-month period, and that would come down to $3,333 a month. But her savings is $5,500. So that means, if these numbers are accurate, that she has to work 1.65 months just to make up for the money that she's overpaying in self-employment tax, or 1.65 months, 50 days. So 50 days of work. So if you're watching this live, you can do the math 50 days from now. If you're watching the recording of this, whenever you're watching this, just look at the calendar and count out 50 days. That's how many days you're working for free because you didn't take a minute and spend a few $100s to incorporate everything you do. So I want to come back to this, because this is the important part. Whatever you take as a distribution is exempt from this 15%. That's why this number goes down, because she's only paying the 15.3% on the salary portion. So when people learn this, they go, oh, great, I get it. I'll just take all my money as a distribution. Well, unfortunately, you can't do that because the IRS says you must take a reasonable salary. And Tony talks about what a reasonable salary is on his section, so I won't go into that. But just a rule of thumb, how would you decide how to break down your income between salary and distribution? Well, I don't know. I'm not a financial advisor. So what I did is I did a lot of research, and I follow this gentleman that is just unbelievable. And he does a lot of things. His name is Sandy Botkin. Sandy was a CPA with Deloitte & Touche and an IRS tax attorney. Pretty well credentialed guy, right? And as an IRS tax attorney, what did he do? He trained the attorneys at the IRS on the tax code. So I would say Sandy knows the IRS tax code pretty well. And if you want to make a $15 investment, go out and buy his book, Lower Your Taxes Big Time. He's got a whole chapter on there devoted to how to eliminate up to 60% of your self-employment tax with an S-Corp. So that's exactly what we're talking about today. This is not debatable. Everybody in the industry says this is the way to do it. So we're just trying to add some clarity to you to go out and have all of the tools to make an informed decision. So Bodkin says 40 to 60% distribution is okay. So I took a 60% in my example. But again, that's up to you and your particular financial advisor. This is not financial advice. But go grab that book, Lower Your Taxes Big Time. It's for $15. It's well worth it. Okay, so I think we've beat up pretty well why you should incorporate from an asset protection standpoint and a tax saving standpoint. And because this course is all about tax savings, Tony's going to add some fill in on around that. But I just want to finish up some of the other benefits that you get if you do decide to incorporate. You get additional credibility. You get to put those initials after your name. And a very small percentage of realtors are incorporated, right? I've been doing this for 8 years in Florida, and the vast majority of Florida realtors are still not incorporated. So if I walk into a listing appointment and I have a PA on my business card after my name, I'm going to explain what that means to my prospective seller. And they're going to understand that, hey, this guy understands business. He understands how to protect himself, protect his personal assets, and he also understands money because he's doing the things to minimize his tax obligation and hold on to as much of the money as he can through tax strategies. Maybe he'll do a better job protecting my interests in the sale of my biggest asset, my home. So it does get you additional credibility because the vast majority of realtors do not have a corporate entity. Last benefit, lower risk of a tax audit. I watched Tony talk about this on a previous class. You know, when you're a corporation, the auditors that audit corporations, they're looking typically at big corporations. So even if you do $250,000 a year as an S Corp, as a realtor, as a PA or an LLC, that's a small corporate entity. So they tend not to look at them as closely. Not saying you'll never get audited. We know the IRS is stressed for resources right now, so your chances of an audit are lower to begin with, but why not make them even lower with a corporate entity? Okay. Let's talk about some of the things you want to do. Again, this is state by state, but if you decide to form a corporate entity in your state, a couple things you want to do. You want to understand the rules of your state. Let me first tell you why the percentage of realtors that have incorporated is so low. It can be costly. I've seen it $600, $800. I have a friend, he's an attorney on the west coast of Florida. He charges $1,250 to do this, so it can be costly. And then there is a perceived complexity issue with this. People think, you're not applying for a mortgage, right? They think, I need multiple months of bank statement, multiple years of income taxes. No, my company has created this form. It's online now, of course, but there's just some key information that we need to file for your corporate entity in your state. But there are rules in each state. This is where you need to talk to your real estate commission. Like in Florida, the naming convention is pretty strict. You can have a PA or an LLC, but it must be in your name. So I can't have Dahlia Dream Homes LLC. Can't have it. I just can only use my name that's on my license. Stephen M. Dahlia PA, Stephen M. Dahlia LLC. In certain states, there are predominant entities. In Florida, the predominant entity is a PA. Doesn't mean an LLC is bad, just means more people choose the PA because you get in that group of professionals, right? In Georgia, the predominant entity is an LLC. In Pennsylvania, a corporation, state fees are $425. An LLC is $100. So the predominant entity in Pennsylvania, surprising, is an LLC. It varies by state. The naming rules vary by state. So, and also whether or not you can even incorporate varies by state. Like, I know we probably have a lot of people from New Jersey watching this training. Unfortunately, New Jersey is one of those states that doesn't allow realtors to incorporate. So make sure, I know some of the rules in some of the states, so check with me, but you want to check first and foremost with your real estate commission. All right, so I have a service. We talked about it. I'm going to introduce you. If you want to take advantage of it, it's fine. My company provides a lot of the functions. We do the name search. We do the electronic filing. We get your articles of formation from the state. We get your federal tax ID or your EIN number. We fill out the form. That's Form 2553. That's the form where you tell the IRS you want to be taxed as an S corporation. In some states, there's real estate commission forms for compliance. In Florida, it happens to be the DBPR RE16. And then you call me anytime with any questions. And then I have a link, whether you incorporate with me or not, ask me for it. I'll send you the link to banking promotions where you're probably going to want to open a corporate bank account, and there's a lot of banks that are offering different promotions. So let me just show you, if you wanted me to do your incorporation, where you'd go. You go to my website, allfilings.com. I did a couple screen grabs. That's why you see the chat on the right. The vast majority of my business is Florida, so that's why right underneath the hero image there with that young lady, you see on the left Florida Realtor PA and Florida Realtor LLC. And then under that, I do a lot of Florida non-realtor entities like plumbers, window washing business, whatever it may be. And then if you're not in Florida and you want to incorporate, you would just go to that bottom right box there where it says non-Florida entities. Then it's going to bring up a screen like this where you're going to pick your state, and then you're going to come here and you're going to pick on whether you want a corporation or an LLC. And then all you're going to do is on the bottom of this form where it asks for payment, there's a little thing that says coupon code. And for people that are watching this training, I've added a little courtesy discount of $50. So if you just type in WORKS50, it's going to reduce that price by $50. And then once you pay, it takes you to a form like this. You fill it out. It comes to me, and I process it with the state. And then a few business days, you're live. And that's it. Now, this is my last slide, but this is it's not my last slide, but it's my most important slide. People say, what happens next? How long does this take? So, depending upon your state, we file and then we wait for the state to create your articles of formation. I've seen it as fast as 1 day. I've seen it as long as 3.5 weeks. It depends. And once it's in with the state, we can't control it. Some states have expedited filing. Most don't. You put it in, you wait. So if you've got a closing coming up, don't wait till the last minute, because we can't rely on the state to turn it around fast. Once your entity is live with the state, we jump back in and we secure your tax ID number. Once you have this and this, I'm looking at the wrong screen here. I'm not showing you once you have your articles and your EIN, you can open a business checking account. Then if you're in a state that has a real estate commission, like in Florida, we have DBPR, you have to do a form. We handle that. That usually in Florida takes about 3 to 4 weeks now. It used to be 2 weeks pre-pandemic. And then a lot of times I say this is my most important screen, and this is the most important box on the most important screen. This is the one you want to make sure gets done, because this is the form that gets you that S Corp status, which is where this tax savings come from. Without that, as a corporation, you're a C Corp, you pay double taxation. As an LLC, you become a sole proprietor, there's no tax savings there. And then there's a couple things you want to do. You're going to want to open, by the way, let me just go back to the 2553. We have 75 days to file that. If you're late, it's not a big deal. We always do it right away. But if you're doing this on your own or having someone else do it, just make sure they get that 2553 in a timely fashion. So the two things you're going to want to do is you're going to want to open a separate business checking account. I'll send you that link for the discounts. And you're going to want to update your W-9 with your broker. So let me show you, and this needs to be updated, but let me just show you how different this is state by state. And don't go by these numbers because they do change, but Different states, like you look, Arizona, look over far to the right, doesn't recognize S corps. If you go to the bottom, New Jersey does not allow entities. Pennsylvania, I talked about that, right? Oh, I had my numbers, I had them reversed. An LLC is $425 and a corporation is $125. Georgia, $100 both. They all have annual reports. The annual fee for the privilege of keeping your entity open and operating is different in every state. The timing of it is different in every state. So just make sure you understand that. Like in Florida, there's something called an annual report. It's $150 for a PA. It's $138.75 for an LLC. And it's due no later than May 1st. If you pay it on May 2nd, there's a $400 late fee added to this. So $150 turns into $550. If you don't pay that by the third week in September, they shut it down. You want to reopen it, there's a reinstatement fee. So see, like in Florida, the predominant entity is a PA. In Georgia, the predominant entity is an LLC. In Florida, we have that compliance form called the RE16. There's a $30 fee. So can't stress enough that this is a state-by-state situation. And here's another screen really just to make your head spin on the state-by-state. So call me anytime. Happy to walk you through this. I wanted to keep this to 30 minutes. You go to my website, check out my reviews. I've been doing this for a while. I've done over 3,000 filings. Got a lot of happy clients, so you can go check that out at your leisure anytime. I'll just buzz through this, and then I want to get to my last screen. So here's my last screen. Let me just go back one. Yep, there's my buddy Chris. So again, this was the topic. There's my information on the bottom of the screen there. My email, my phone number, the coupon code. Use it on any page. Works 50. I wanted to do that as a courtesy to Russ, providing me the opportunity to bring this education to you. And now Russ is bringing you another tremendous personal resource of his personal accounting company, Tony Pistano, and he's going to provide a lot of extra details for you. So that's it for me, ladies and gentlemen. I appreciate your time and attention. I hope you all have a great day, and reach out if I can